look about what this concept actually means. And we're going to be referring to the US dollar index Smt Divergence. Now, Smt stands for Smart Money Tool or Smart Money Technique. And we're going to be looking for a divergence between closely correlated or inversely correlated assets. Now, obviously, if we expect the dollar index to trade higher, that's going to put downward pressure on foreign currencies. If we're expecting the dollar index to trade lower, that's going to allow foreign currencies to rally. In a symmetrical market condition, when the dollar index makes a lower low, foreign currencies, we expect that to make a higher high. When we see this, this confirms current price action, and the underlying trend is likely to continue. Now, the idea of stalking reversal patterns in this condition is not highly probable. In fact, you want to avoid it altogether. The reason why is because, for instance, let's take a look at the dollar index example here with the red line. Okay, we're going to look at the likelihood of that old low being violated, as we see here. And if we see that old low violated, and we see a higher high in foreign currency, that confirms the down move in the dollar index. And even though it trades back above a short-term high, that short-term high is going to be just a run on buy stops. And then the dollar index most likely will resume going lower. This is one of the ways that I can basically go into the marketplace and anticipate a turtle soup before it actually happens. And the same thing said for foreign currencies. If we see that higher high while the dollar index makes that lower low, price is confirmed. So that means the underlying direction is still intact. So any movement down in the foreign currency pairs below a swing low or a short-term low, they're gathering up the sell stops below the marketplace. And that's where they're going to be accumulating new long positions. And then the foreign currency pairs will be allowed to trade higher and make a new higher high. Now, when the dollar index makes a higher high and the foreign currency makes a lower low, this too confirms current price action, and the underlying trend is likely to continue. Again, like we just said about the other slide, the idea of stalking reversal patterns in this condition is not high probability, and it should be avoided. Again, once that dollar index makes a higher high and the foreign currency makes a lower low, that run above the short-term high on foreign currencies is many times going to be a run on buy stops above the marketplace, and then you'll see another sell-off making a lower low. And the same is said for the contrary for the dollar index. When the market trades back below that short-term low, it's going to gather up sell stops to pair new buying with, and then it'll most likely trade higher and make a new higher high. Now we're going to talk about non-symmetrical market conditions. When the dollar index makes a lower low and the foreign currency fails to trade higher than a previous high, this is US dollar index SMT or USDX SMT. This does not confirm current price action, and the underlying trend is likely not to continue. However, the idea of stalking reversal patterns in this condition is high probability and could reasonably be considered. That lower low on foreign currencies is indicating that the dollar index is most likely going down below a previous low to do what? Wipe out the sell stops, accumulate new buying, and the rally should ensue in the dollar. If the dollar is going to rally, that means there's going to be downward pressure in foreign currencies, and it's already shown itself in the form of weakness by having a failure swing in the foreign currency making a lower high. Again, looking at non-symmetrical market conditions, when the dollar index fails to make a higher high, while foreign currencies make a lower low, the same thing is being said as we said in the previous slide. It's just being illustrated in a different context. This is showing the dollar index is failing to make a higher high. That means there's underlying weakness. And there's a lower low seen in foreign currency pairs. They're going down below a previous low to accumulate all the sell stops on foreign currency pairs. Then they'll rally the market higher. The dollar index will sell off, which would support foreign currency long positions, and the underlying weakness is indicated with the US dollar index making a lower high, fuels those market moves. The idea of stalking reversal patterns in this condition is high probability and could reasonably be considered. Okay, so let's take a look at a case study here. What does this look like in price? Okay, we're looking at a daily chart of the British pound USD, or as we call it, the cable. And notice the highs in here. Okay, we have a higher high formed in pound dollar. This is around the end of April going into mid-June of 2016. In the same time frame, we see the dollar index making a low in April time period going into mid-June. But notice the difference between the two. Going back to the pound dollar, we have a higher high forming in the middle part of June 2016. By itself, at the time when it was rallying up, I'm sure it probably looked very positive and bullish to everyone. But if that's the case, if there is a symmetrical market condition, that should be seen with what in terms of the dollar? It should be seen with a lower low. Do we see a lower low form in the dollar index? No. That's a USDX SMT bullish divergence. That means what? We're seeing underlying strength in the dollar index, and even though this looks bullish on the British pound, it's really just taking the buy stops above the 47.60 level. Once those stops are ran out, the market does in fact tank. The underlying strength in the dollar index allows us to look at that 93.80 to 94 big figure, this down candle in here. That may become a future bullish order block that we could trade at. Once this void is closed in, we know that there's underlying strength in the dollar index because there was an unwillingness to see that lower low form as we saw the higher high form in cable. So again, you can see that that higher high piercing an old high, that's going to be a run on stops above that 47.60 level. Now it trades almost up into 50.65, which is like several hundred pips, but it's a daily chart. So we're going to be cognizant of that, but nonetheless, we're looking for institutional market structure. So this looks like, by all indications, when the market was rallying up, retail traders and less informed traders would see that as a bullish breakout, but it's not seen with the dollar index having a lower low. So we see the same thing we mentioned earlier, just graphically described here, the higher low formed on the dollar index. That should have created a lower low as the cable made a higher high, and it didn't. And what is that actually giving us? It's giving us a great insight about what is being accumulated. The dollar index is being accumulated on the long side. Otherwise, it would have been permitted to go lower. If we see that, and we can see a foreign currency pair shooting higher, okay, basically acting on its own accord, if you will, okay, that's not by accident. It's absolutely a manipulation. So if we understand where the manipulation is taking place in the marketplace, then we can go in and capitalize on that. So now we can focus primarily on being bullish dollar. Why? Because the dollar was unwilling to make a lower low. And the only reason why that can happen is if it's being bought aggressively. Otherwise, they would wait for lower prices. So since they're unwilling to wait for lower prices in the middle of June of 2016, we have to focus primarily on being a buyer on dollar. And that means put sell signals or bearish stance on all foreign currencies, looking to be a seller. This is the reason why all through the second part of 2016, I've been a dollar bull. Okay, let's take a look at another example. And we're going to be using the daily chart again, because I want to build the idea that you don't have to be a day trader, but having these ideas will help us have a long-term to intermediate-term perspective on the marketplace. So now we're going to turn our attention to the latter portion of August 2016 to the first week of September. And you can see that the cable made a higher high. Okay, so all indications here looked very bullish. Okay, so price was running through an old high here. At the same time, this low on the dollar index here did not see another lower low. So as the cable was pressing higher, rallying, this dollar index should have seen a lower low. It did not do that. What that indicates is, again, dollar-based strength. In other words, the dollar index is being accumulated on the long side. The cable is being distributed. Now, it's being distributed above an old high here, but look to the left again, above this old high here as well. So now we can go and frame another level for turtle soup, or a false break above an old high to run what? What type of stops reside above an old high? Buy stops. Why would they want to take the market up to a buy stop? Because they want that buy stop to execute at the market, to buy at the market. They're going to sell their long positions they accumulated here and they accumulated here. They can sell those longs at a higher price to willing buyers up here. This is being distributed. It's being distributed at an old high while the accumulation is seen in strength because the dollar can't go lower. Now think, if the dollar doesn't go lower, it's because it can't go lower because of pricing. It's being kept while the premium is being built into the pound dollar. So retail chases this run like this and false breakout, while smart money looks at failure swings on the lows. When you see what would otherwise look like strength and breakouts on the upside in foreign currencies, always double check them with the dollar index. If you don't see that, then you know that the false breakout on the upside on the foreign currency market, it's all sucker play. It's retail Candyland. Everyone's going to be looking to be going long on those false breakouts in foreign currencies, while the smart money is focused in on the dollar having an unwillingness to go lower like it does here. So this low, and I basically framed the exact dates. That's why this box is up here. So it's not like a kill zone or anything like that. I'm just giving you a specific date range to look at sample size of price action. As you look at this, I want you to see just how strong it is in terms of giving us a long-term to intermediate-term perspective on what direction the market is going. Now, again, this is a daily chart. So if they're going to keep price at a higher price low here and not blow out the previous low or this low over here, we see the unwillingness to hold these prices in British pound USD. They quickly drop it lower because it's been distributed. They left the retail holding the bag. When accumulated long positions start moving higher, every time there's a retracement, we expect to see another expansion on the upside. So when we look at price like this, we can see it graphically using the price chart, but I also